Okay, so question 4 is tricky. They give you, if you look at these pop-ups, they give you three financial statements. And if we go back to in the PowerPoint and these how these financial statements are related, you have a beginning balance sheet, and that gives you your beginning retained earnings. And then over the course of the year, you generate income, you buy things, you sell things, you spend money, and you hopefully generate a profit. That also goes into the statement of retained earnings. And then you have your ending retained earnings as well, which gives you the retained earnings in the end of the year balance sheet. In your retained earnings statement, you start with your beginning retained earnings. You add in the earnings or the profit or loss from the year, right? Because profit or loss is like synonymous with earnings. And then from that, you subtract out what you pay to the owners. So any dividends gets subtracted out in the retained earnings statement, and it's the only place where you ever see how much was paid out in dividends. It's the only place in any of these financial statements that gives you that. And then your ending retained earnings goes into your ending balance sheet. So this is like the real relationship between these three financial statements. And that homework assignment asks you to provide one number for the distributed earnings or the dividends that are paid out. So you got to go through a ton of rigmarole to get that one number. This is like this is a complicated problem. So the other thing to note is that they give you data, but they also kind of like throw aside or throw out like just this little, extra bit of information in the instructions here, right? So, you just gotta read it carefully. So here we have all our data. And so we've got, again, just to kind of step back and look at what we're looking at here, right? We have got a balance sheet at the beginning, right? At the end of 2016, we've got a partial income statement, and these are actually partial balance sheets. We've got a partial income statement for the year of 2017, and then we've got an ending balance sheet. So if you think about that PowerPoint where we had a beginning, I'm trying to think of which hand it is, I guess for you, it's this side. Beginning balance sheet, income statement for the year, retained earnings statement for the year, and then the ending balance sheet. We're going to make those connections in this problem. Okay. So first thing we got to do is copy all three of these tables over. And then I also want to note before we get started that I've given you instructions how to do this because it's a little complicated. So the first thing we want to do is we have to construct a full income statement, and then we want to construct full balance sheets for both of those years. And then once you have all that, then you can do the retained earnings statement. So we go ahead and copy these. Paste it. And I should note that this is a partial balance sheet, or I'm sorry, a partial income statement. And then the other thing is you probably want to add some rows. You want to insert some rows here. This is too crowded. Let's go ahead and insert rows before we put in our balance sheets. Okay, now this, I want to note that we should probably label this partial balance sheet. You know what, here. This is our beginning balance sheet, right? It came first. All right. And now here comes our ending balance sheet, same deal. Okay, and I'm already bumping up against the end, so let's add in some more lines. Some more rows. All right. Give this one another row in between just to make it a little bit clearer. So this is a partial balance sheet for the end. Okay. Okay, so step one, we want to construct a full income statement, and let's do that. I'll tell you what, let's make this smaller, make this bigger and wider so that you can see better, thusly. All right, so let's make a full income statement over here in column G. Now, what goes into an income statement and in what order matters a lot. And so if you can't remember how to construct an income statement, you look over here in the PowerPoint, right? And so let's take a look in the lecture notes for how to construct an income statement. Here's one. So it goes revenue, cost of goods, depreciation, selling in general, other expenses. So you see the order, right? So hold that in your head or flip back and forth. Okay, I'm not going to flip back and forth because it might be like jarring for people's brains. I know this stuff already, but if you guys don't know this stuff already, flip back and forth. It's helpful. All right, so here comes our income statement. So what I'm going to do is do the column heading first, and then fill in the numbers after, because it's easier for me. So it goes revenues, cost of goods, gives us gross margin, and then we subtract fixed cost, SG&A, and depreciation. Okay, I'm gonna it's just easiest to when you're doing this to lay it out so you can follow all the subtotals. Okay, and then this, after we subtract out those other expense categories from the gross margin, we get to EBIT, earnings before interest and taxes. Put that back out. And subtract from earnings before interest and taxes, you subtract out interest. And that will give you taxable income. And then subtract out taxes. And that gives you net income. Okay. So now let's go ahead and fill in all these numbers, okay? So you do that always when you're working Excel. You do that by using cell references whenever you can. So our sales revenue is here. Cost of goods sold. That gives us our gross margin, which is revenues minus cost of goods. Subtract out these other expense categories, our fixed costs, and our selling in general, and depreciation. And so you subtract these three categories from the gross margin, and that gives you your earnings before interest and taxes, or EBIT. And then from that, you subtract interest expense. Now notice, right, they give us this little, aside over here in the instructions, right? So you got to remember to go back and look at the instructions. So we're going to subtract out our interest expense of $18,000. And so then our taxes, again, it's 40% of the taxable income. So you multiply that 75,000 times 0.4. And that gives us our net income. Okay, so there's our net income of 45. So again, refreshing our memory to that those connected balance sheets, right? So we go balance sheet at the beginning, you have beginning retained earnings, add to that the net income for the year. right? So we've got our net income for the year. And even though, like, as we're looking at this spreadsheet, I'm sorry, at this sort of cheat sheet for how these financial statements are connected, when you're actually constructing financial statements or doing recording, you start with an income statement, always. Always. Okay. So now let's take a look at the balance sheet. So we are missing, we said this is a partial balance sheet. And so I want to draw your attention over here to our fixed assets and accumulated depreciation. Okay. So that's what makes it, there's a few things that we need to pay attention to in the balance sheet. The fixed assets and accumulated depreciation aren't finished yet. We still also need to calculate the net fixed assets. So remember, fixed assets are recorded as their original purchase price, and then you subtract out the accumulated depreciation to give you your net fixed assets. Right, so let's add a line here and make it so it's not filled. Okay, so that's the first thing. We got to calculate net fixed assets as fixed assets minus accumulated depreciation. Okay. And then the other thing is, we still don't know what our retained earnings are at the beginning. Okay. We have to back into it. This is a puzzle. I love puzzles. And we have to back into the retained earnings. Okay, so this is a partial balance sheet. But now that we've calculated the net fixed assets, we can go ahead and complete the total assets, which is the key to it all. Okay, let's make that bold and italic so you can see it. Now our total assets are going to be all of these short-term assets, all these current assets, cash, accounts receivable, and inventories, plus the net fixed assets, plus the intangibles. So our total assets are $400,000. Okay. Now, we know that our total assets are $400,000. Therefore, we know that our total liabilities and equity have to be equal to $400,000. So let's go ahead and fill that in. Okay, by the way, a little Excel trick, which is kind of a new trick to me, and I love it. I know I want these cells to be bold and italic, right? Rather than hitting bold and italic in all these cells, I can use this little paintbrush up here, and that copies the formatting here, and I can format both of these cells over here, and that just automatically makes it bold and italic, which I think is cool. So our total liabilities and equity has to equal this $400,000. So now I can go ahead back in there and get that beginning retained earnings. I know that the beginning of retained earnings is going to make up the difference between all these liabilities and common stock and the total liabilities and equity. All right. So our retained earnings is the difference between that. So it's all these guys up here, all these liabilities. Oops. Plus the common stock. And then, you know what? I did that formula a little backwards. Let me restate that. The value in the retained earnings account is going to be this total minus all of these guys. So it's the total liabilities and equity minus the sum of all the liabilities plus the common stock. Okay, so it's the remainder. Okay, so let's state it as it's going to be that 400,000 minus the sum of the liabilities minus the common stock value, 47,000. Okay, so that's our beginning retained earnings. Okay, we got to do the same thing for the ending balance sheet. So let's go ahead and what did we do here? We added a line here for net fixed assets. And we can go ahead, because we're lazy and it's Excel, we can go ahead and copy that value. But, I'm sorry, not copy the value, copy the formula. But, haha, we are missing something in this second year balance sheet. We are missing the value in accumulated depreciation. Why? Because it's going to be different. Over the course of the year, in the income statement, we have taken depreciation expense. You see? So the value of the accumulated depreciation, every year, depreciation grows and grows as new depreciation accumulates. So the accumulated depreciation is going to be bigger by $46,000 than it was last year. So our accumulated depreciation is going to be this 142 plus the 46 new depreciation from this year. So now it's 188. And because I set up my formula properly here, this extra line that I put in automatically recalculated. It worked. Right, so now we can do the exact same thing with the retained earnings. Okay, so how about, if you notice we have a blank line here, how about if I go ahead and copy these formulas and put them in this row here where there's a blank line up above and it's calculating properly, right? So our liabilities and equity has got to be the same. So now we could even just calculate this, or copy this retained earnings calculation and put it down here. And now we have 62,000 in retained earnings. Now we're almost there. Almost there with number 4. Okay, let's go down then to the statement of retained earnings blank that I gave you. And now we can just go and grab the values. Okay, so we have our beginning balance in retained earnings was 47. Our net income was 45. We don't know what our ending dividends are, or what our dividends were that we paid, but we do know what our ending retained earnings was. Right there. So now we can calculate the dividends paid as the difference between, so dividends paid are the difference between the beginning balance plus net income minus the ending balance. So let's go ahead and calculate that. So that's $30,000 in dividends paid. All that rigmarole, having to do every single one of those from scratch to get to one number over here, 30 grand. There it is. And that's how you do number 4.